Hey, everybody. Hi, Jim Kruzan here, and welcome to the Market and Economic Update for the month of May. This will be a really short report, so just hang tight. Uh, First and foremost, the leading economic index, something we've been talking about for a long time, continues to drop. We'd like to see a Nike swoosh, which would indicate the worst is over and things are improving, but we just don't see that. Month over month, the numbers get a little um, wobbly. 2 months ago, there was a slight uptick. Last month, there was a slight downtick, or vice versa. You see that quite often. If we get into the weeds of some of the economic data, it's kind of a mixed bag. If we look at the third from the top, that would be credit card delinquencies. You'll notice that they're up. And in fact, they've been up the last several quarters in a row. Most recently, 13.12% of all credit cards are at least 90 days late. That's up from 12.7 and 12.3 the 2 quarters before. Also, in the consumer mortgage space, think of that as mortgages on office buildings. They're having their own share of problems as delinquency rates remain very high at just under 12%. Additionally, on the manufacturing front, a little bit more positive news. The manufacturing new order index was up, as was the PMI index, which is good news. At local levels, again, mixed bag. The Philly Fed reported a decrease in business activity, while the Chicago Fed reported an uptick. Inflation is now a bit of a concern. Core PPI, think of that as input cost, rose a full 1% in the month of May, a huge increase. And prices year over year have risen 5.23. Generally, that's a precursor to higher inflation. Core CPI, Consumer Price Index, for the year is still 2.7% year over year increase, but for the month it was a 0.38. So really close to a 4% run rate, which is quite high. Remember, the Fed's target is 2%. There's also a bit of a mixed bag with respect to employment. Initial jobless claims, unemployment, rose. It was up 2.3% greater than it was the prior week. The ADP employment, that's a payroll service, saw that there were 109,000 jobs created in April. That exceeded the forecast by about 15 or so thousand. But at the same time, when you look at the U.S. employment number, they showed jobs increasing at 115,000 in April, which was significantly below the 185,000 in March. So somewhat of a mixed bag. The JOLTS report, which is job losses and hires, essentially was unchanged. So we're still in an environment that can be best called no fire, no hire. So that's kind of where we are on the economic front. And it's been the same story for many months now in a row. At the same time, we're faced with an even more expensive market than we had just last month. The Buffett indicator, which we've looked at before, dropped a bit from its all-time high in December. By the end of the first quarter, that number was 219%, meaning the stock market is 219% higher than our GDP. If you're measuring productivity, that would suggest a strongly overvalued market. That number was down because where we found ourselves in March, the stock market had fallen about 5% from its peak at the end of the year. Unfortunately, if we look at that number now, as of just this week, the 1st of June, we're at nearly 240%. And you can see at the tail end of that, it's now going parabolic. That's a bit of a concern. Can it go higher? Absolutely. but we also know valuations are getting really stretched. As I mentioned before, for a variety of reasons, academics don't really like to use the Buffett indicator. When you buy a stock, you're buying productivity wherever they generate business, yet it's being reflected against just US GDP. Academics prefer the Shiller index, which is a PE, price earnings ratio, inflation adjusted, and also earnings are cyclically adjusted as well. So you can use a data point today and compare that to any data point anywhere along the line. You can't do that otherwise. Clearly, earnings, revenues are higher today than 10 years ago. How much of that is inflation? Anyway, the Shiller index is 41.5. Now the second highest ever recorded, higher than last month, higher than a quarter ago. The only time it was ever higher was about 43, and that was during the dot-com bubble, when technology stocks, specifically internet-based, skewed the market much higher. And we're seeing a bit of that today as well. If we want to look at kind of what happened for the month, the S&P was up 5% for the month of May. That's a huge gain for the month. It's now up about 10 for the full year. And equally weighted S&P, same stocks, just not cap weighted, we're up just a little over 2. In the world of bonds, mostly negative, as the 1 to 3 year, the 7 to 10 were all negative. And the Barclays Ag Index was also negative for the month as well as the year. The US dollar rose and gold fell. There was some hope of a deal with Iran. And as a result, there was some euphoria and some strength to the US dollar. I mentioned the dot-com bubble and the skew in terms of valuation, causing many of these metrics to look very expensive. As we see it at the end of May, the Mag 7, Apple, NVIDIA, Google, Microsoft, Amazon, Meta, and Tesla, in the aggregate now represent 35% of the S&P index. Remember, there are 502 stocks in the S&P. And the top 10 names today represent almost 41% of the index. That's huge concentration. There was a JP Morgan white paper that was written recently trying to ascertain the AI exposure to the S&P 500, looking at the Mag 7 and other stocks that are AI adjacent, stocks such as Oracle, Micron Technologies, Broadcom, companies that are involved in data centers, companies involved in rare earth mining for battery and alternative energy for data centers, etc. That number now is 57% of the S&P 500 index. So the index, which is supposed to be a good reflection of the US economy, is clearly skewed toward this one element of our economy, not unlike where we were 25 years ago during the dot-com bubble. So if at any point those earnings slow, expectations drop, we've got a tremendous amount of exposure to the S&P, vastly more so than we found ourselves during that period of time we all recognize as a bubble, which was the dot-com. Anyway, we'll see how that progresses this month in June and certainly throughout the summer. So stay with us for our next update, end of June, which will be the quarterly update. So we'll get into the weeds a little bit greater in detail. If you have any questions, please reach out. And as always, thank you. Talk to you soon. Have a great summer.